Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. 6 Mondays ago, the market reached up and touched the significant resistance of the very shallow and old upper tine of the 2017-2018 bullish shift pitchfork, currently at 20,200. Along with this, there was the corralling effect of the September 2014 high, 19,935, and the June 2014 high at 20,000 even. All these capped the market's rise at the time, and their rejection of the bullish incentive caused the drop that was only halted by the slowly rising long moving average, currently 15,880. Since then, the market has been framed in between the long moving average below and the middle tine above, currently 16,705, of the same shallow bullish shift pitchfork. This back and forth action, running for 4 weeks plus now, is obviously indicative of overall indecision. Not on an intraday scale, but on an interday scale. Hence, I've looked at the drop from the high, and especially the drop from Wednesday, the 3rd of March, as a possible bear flag stroke halfway hesitation type action. This is not certain by any means, as the long moving average support continues to look solid, and the middle tine overhead resistance is likewise pretty tough. That is why I've placed a preliminary target X in the 13,725 area, from where the market dropped from just under the August high at 18,850. A more whole pattern target, X1, in the 12,360 area, is at the bottom of my daily chart. My only concern is that this thing has gone on way too long to be helpful. It may be that the long moving average is currently impenetrable. One final thing to remember, and it is an important one. The whole pattern target X1 is below the lower tine, currently 13,210, of this mildly bullish shift pitchfork that has so excellently framed the action in recent weeks. It would surprise me to see the market wishing to push below the lower tine to breach it, or be broken in such a move lower, right now at least. LME 3-month zinc. I wrote back in November last year how the bullish incentive was still alive. This was due to the, and I quote, shallower bullish shift pitchfork for the same move, that's the early July to early October 2020 move. It had, at the time, the upper tine, currently at 3209, had held down the top of the market back in late November 2020 and mid-December 2020. I added, so, while superficially the market may be topping and looking sideways to a potential move lower, the reality is that the bullish incentive is still alive, though at a less acute angle. It all depends on what the market will do with the big old 50% Fibonacci line at 2806, because there's a lot of support below and also resistance above. End of quote. Since then, the market first chose to punch lower, actually exiting out of the bottom of the bullish shift pitchfork. However, there were mitigating circumstances. I wrote 12 weeks ago at the end of my commentary, and I quote, "We seem very much to have formed a large rounded top, with elements of a triple top within it. The potential for a triple top would be where target X is placed on the daily chart at about 2578. End of quote. You see, target X was the reason the market exited the bullish shift pitchfork in the first place, and it was the only reason. As soon as target X was achieved, prices started moving right back up again, halting only just before the April 2019 high at 2958. Since then, prices have dropped, prompted by a weekly key reversal down at the end of February, holding on a closing basis by both the flatlining short-medium moving average, currently 2766, and the gently rising medium moving average, currently 2772. This is how we've ended up back where we started at the 50% Fibonacci line at 2806. The problem now is that time has moved on, and the lower time, currently 2812, of the original shallower bullish shift pitchfork that I mentioned earlier is once again under threat, as well as the lower time, currently 2817, of the early October 2020 to early February 2021 bullish Andrews pitchfork. 4 weeks ago, I postulated the following, and I quote, "To have the market slice so swiftly and cleanly through all but the uptrend on the downside is a wake-up call. The reason to wake up is that the action from November 2020 to date may be building a possible double top, a large one. Hence, caution." End of quote. I still stand by the sentiment of that day. It is a wake-up call. However, I added a caveat 3 weeks ago. In addition to the large double top idea, we may also be forming a possible diamond pattern over the December to date action. Now, it's not a pretty looking diamond, but it has merit. What is more, the market has exited out of the top side. The question I posed then, which still needs to be answered, is whether this is a true or false break higher. The 50% Fibonacci line, the short medium moving average and the medium moving average have seen to that, giving no answer for the 4th week so far. Thank you for listening. This short version broadcast, this weekly broadcast, gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.